we observe that the climate tech market necessitates the creation of this new asset class. It will be outsized returns compared to traditional value add infrastructure, but it will bring and marry these two sectors to enable all these technologies to graduate into commercial scale, into being able to solicit project debt and get other creative and lower cost of capital solutions. So that's really important. So, that's an aspect of what we do at Wavelength. And separately, we work with a lot of these companies because it's also really important to provide the education into the ecosystem. And so we work with a lot of these companies to help them who have typically demonstrated their technology at scale. We work with them to help them prepare against this new reality where, there is no more free money, like help them understand and map who the stakeholders are, create their financing roadmaps and industry connectivity in order to be able to find who the right capital partners are and how to sequence and structure, their plans in order to, maximize the success of their early commercial facilities.
Hi, everyone, and welcome to Climate Tech 360, where we connect with diverse voices in the climate sector to make informed choices in supporting the future of climate technologies. I'm your host, Samia, and today I am speaking with Petros Lakakis, one of the founding partners of Wavelength Infrastructure. Wavelength was formed by two climate infrastructure investors to define, structure, and solve the funding gap between the successful demonstration and true scale-up deployment of decarbonization pathways. Wavelength seeks to bridge this gap through predominantly project-oriented equity capital structures and by leveraging the full early climate infrastructure ecosystem, including catalytic capital, strategics, incentive programs in partnership with the technology and project developers. They believe these investment structures will unlock scale deployments of the technologies needed to accelerate the advancement of the net zero economy. Petros has a decade of experience investing in value-added infrastructure projects and operators. Before starting Wavelength, Petros served as an operating partner at Energy Impact Partners, and prior to EIP, he was an infrastructure investor at Stonepeak, where he originated and executed multi-billion-dollar investments in the transportation, telecom, and energy transition verticals. He began his career at UBS advising industrials and infrastructure companies. Petros holds an MS in civil engineering from Stanford and a BS/MS in civil engineering from the National Technical University of Athens. In this episode, we cover what it takes to finance a first-of-a-kind project, also known as a FOAK. We discuss the different players involved in financing a first-of-a-kind, where the gap is, and how Wavelength is addressing this gap, case studies and recent transactions in this space, how we can learn from the deployment of financing more mature technologies like wind, solar, and liquefied natural gas, and finally, a checklist for founders to get ready for raising money for a first-of-a-kind. And now, on to the episode. Hi, Petros.
Hi, Samia. Thank you so much for having me on your podcast.
I am so excited to have this conversation. We've chatted a little bit briefly, but I'm really excited to dig into everything. So I thought we could kick it off with just your definition of what first of a kind means. I know that it mostly relates to technology, but it can also reference a new end market or business model. So let's kick it off with what you mean by first of a kind.
Sure. So when we think about first of a kind, particularly in the climate tech space, it comes down to hard asset companies that have developed a technology at the demonstration scale or pilot scale and are looking to now develop their first or deploy their first commercial MVP. That is really what first of a kind comes down to. Why is it important? Per the IEA, 35% of CO2 emission reductions needed for us to reach net zero by 2050 will come down from technologies that are still today under development. That is why first of a kind is so important, because there's urgency, and we will need a lot of these technologies to graduate from the lab scale today into deployment, tens and hundreds of millions of dollars globally. And, when I think about it, it's like, when we think about first of a kind, it really takes expertise and skill sets that come from two historically very discrete asset classes. On one hand, you have venture capital backed firms that are focused on what's the total addressable market, what are the management teams, what is the technology specifically do, how do you commercialize this business model? And then on the other hand, you have the deployment at scale that comes from infrastructure investors. And infrastructure investors, focus on risk management, structuring long-term contracts. How can you bring those two together and bridge that what we call the second valley of death in the climate tech space. And that's what first of a kind comes to plug in, because first of a kind draws the interest of the infrastructure space, and we like to think about them as the solars of the future or the wind of the future. I prefer to call it emerging or early climate infrastructure, because the infrastructure universe, it hates disruption. It hates the word first. That we want to as infrastructure investors, you want to find a mature technology with low risk, with the ability to price defined and volume defined contracts, and able to and be able to deploy these at scale across portfolios that are tens and hundreds of millions of dollars. And I think that's what's really important here. It's how do you bridge that gap, and that's where first of a kind comes in as an asset class of potentially of itself.
I think you just hit the nail on the head, because you're a debt provider, like you've lost them at the word first. Like we really there's a PR problem that we need to address. We have to stop calling it first of a kind. Truly, somebody comes to you and the immediate thing that you associate with first of a kind is incredibly high risk, which is not what debt providers do. So early infrastructure, I'm going to try to be diligent about calling it early infrastructure and not call it, feel free to correct me. But the other thing that you talked about is really like this, it could be a valley of death. People call it the missing middle or bridging the financing gap. I think it's a chasm. It is a chasm between an equity as an asset class and debt as an asset class, right? What equity providers look for is so different. They're so ready to take on the risk. There's unlimited upside. Debt providers look for exactly the opposite, right? They want safety and they want all their money to be paid back, and they're not, looking for outsized returns. So how do you really bridge that gap? Because it's a huge gap. It's a chasm, really. So going back to the early infrastructure problem, who are kind of the key players that are going to be involved in this?
Yeah, and you're raising a great point, and I would even add to that, you don't only have, different language between, equity and debt. You have different types of equity. You have infrastructure equity, you have venture capital equity, you have debt providers, you have structured equity players. So there are just so many tools and types of capital that are critical for this space. And as a first of a kind or early of a kind developer, or a climate tech, startup, you need to think about your first of a kind plant years in advance before you get to build it, and it will take years to be built. So, that knowledge needs to all be incorporated in your business plan from day one, from your Series A pitch. So, when going to your question around who the key players are, I like to think about, the industry. It's really an ecosystem. It's not just a specific player per category. I would say early when you look at if the company sits in the middle, when you look further upstream, you have venture capital. These are typically the feeders, the investors that bring you to this stage where you are now ready to take your technology from the demonstration stage, which will cost up to 5-10 million and potentially can be funded from your balance sheet capital, but now you need to commercialize it. So friends in the space include EIP, where I used to be, Fifth Wall, Breakthrough Ventures, Prelude. Then there's a type of capital that is particularly pervasive in this space, that's concessionary capital. And that comes from philanthropy or other impact investors. They typically look to provide what can otherwise be called, catalytic capital, and potentially is a more apt term, because it doesn't, necessarily, it doesn't provide a subsidy for equity, but it really comes in to unlock an opportunity. It's really an enabler. It's catalytic. So, the name that is being heard out a lot, and a very active investor is Breakthrough Catalyst. It's the vehicle funded by Bill Gates, and ran by Mario. He's a fantastic guy. They're very unique. They offer, part catalytic financing solutions, and can have the ability to write these larger checks, and have been pretty active in the space over the past couple of years. Other great examples of catalytic capital players are Prime Coalition. That it's a group that is a nonprofit, and it's looking to unlock to provide capital again that enables companies to graduate from their early stage into commercial scale deployment. And also the Creo Collective is also a great syndicate of family offices and other impact investors that looks to deploy this capital. Then when when we start looking a bit more downstream, about we kind of enter the territory of traditional infrastructure or growth equity. So first with growth equity, there are a lot of interesting players that are starting to think about how to invest in first of a kind. Their business model usually comes with some form of a top co-control. So they're most of the times are corporate investors with some potential project exposure, or will lock up the company for a number of years with their capital. So their business models are differ, but some of the names that are pretty interesting in the space are Just Climate, established by Generation Investment Management. Those guys have about $1.5 billion in dry powder. They're a very interesting shop. They also invested in one of the great FOAK projects, H2 Green Steel. Decarbonization Partners. It's a JV between Temasek and BlackRock. Generate is another big name. They have a lot of dry powder, even though those guys are starting to graduate into bigger and more mature technologies, and as it makes sense, based on the scale that they have. Capricorn is another great example of an investor in the growth equity space. And then when you look further downstream, which is kind of the end game for some of these climate tech folks, you're looking now at the mature infra space, Stonepeak, Blackstone, KKR, the folks with, Brookfield, the guys that have, 5 and 10, $20 billion funds and are looking to, at this point, take no tech risk and deploy at scale. They want to acquire platforms and deploy hundreds of megawatts per year, and that's their strategy. In which they would then either IPO or consolidate, or further down the line sell to institutional investors that are permanent holders of these assets and are just looking for distributions and dividends. And that's really kind of the I would say the ecosystem of the private capital in the space. Obviously, debt and insurance providers are tools that are available to technologies that have been substantially de-risked. For the first of a kind space, it's pretty unlikely that lenders, especially post 2023, and insurance providers will be there. The name of the game for those institutions, at the end of the day, is fees. So you need to demonstrate that your technology or decarbonization pathway will warrant the resourcing required for those institutions that are typically very risk averse to understand the technology and then for subsequently underwrite it. And then the other two I would say the other two categories that I would like to highlight are the government and as well as other multilaterals. They have an incredible leverage effect into the space. Just in 2023, federal investment, was only a little over $30 billion, but it unlocked north of $200 billion. So you have a multiplier effect of 5 to 6x by government initiatives. In the US specifically, we have the Department of Energy's Loan Programs Office that has the capacity of up to $400 billion, between a mix of guarantees as well as direct lending for more mature technologies. The Office of Clean Energy Demonstrations, those guys have north of $20 billion that, with direct lending as well as private capital matching to unlock first of a kind specifically. So that is also a great competitive program. In Canada, you have the Canada's Growth Fund. That structure is very interesting. They and I think it's also a great model for other institutions. What they do is they're former PSP guys from the infra space. And the way they think about unlocking, first of a kind or new climate technologies, they provide basically fixed price offtakes, and they stabilize the price of carbon credits. So, they're able to, give a nascent technology up in Canada the ability to, present a fixed price long-term contract, which, is the road to bankability. And that's pretty critical. And, the US has done that. They've committed $1 billion in hydrogen in a similar fashion. But there needs to be more of that, because that's how you really bridge the gap by, rendering your project bankable. Another example is, across the pond, obviously the European Investment Bank, they have partnership with Breakthrough Energy as well as other programs like InvestEU and Horizon Europe. They're targeting to mobilize, north of $700-800 billion. So those are, very important mechanisms to unlock these first of a kinds projects and then bring these nascent technologies to scale. And finally, the final category that I think is extremely critical is strategic incumbent players, who have stated decarbonization targets and investing arms, and those guys, should be partners to these newer companies and are in many cases. Great examples are, most recently Fervo announced, $204 million round with led by Devon Energy, who's also leader in fracking because of their enhanced geothermal. So there is, there's a lot of synergy there. Boston Metal, a green steel company, announced a partnership with ArcelorMittal and similar investment by them. So you see investment by strategics into these companies, and at the same time, these strategics provide them with offtake contracts, and they give them that visibility into their cash flows to be able to underwrite their first of a kind and early facilities.
Thanks for that. Yeah, I completely agree with you. I honestly don't see a scenario in which we can quickly scale these hard tech companies without strategics playing a massive role, not just in the financing. Like, obviously it makes sense from an offtake agreement perspective, but also there is, and we're going to talk about this a little bit more later, but like there's a huge gap in terms of skills to commercialize these technologies. So by the time it gets to growth equity, or you've done the multiple plants and you're getting to the first of a kind, you have to go to these. The strategics are the ones that actually have the operational and commercial expertise to scale some of these businesses, especially in areas like energy. So I don't see a scenario in which corporates and strategics are going to be playing a massive part. So I would love to hear a little bit about, where is the knowledge that's lacking now, how you plug that gap, and then specifically what your fund is planning to do to plug that gap.
So before the IRA and the current tightening cycle, venture capital and infrastructure were very separate. And with venture capital, it's important to highlight and keep stressing this. You were focusing, as when you underwrite deals, it's about the total addressable market. Who are your co-investors? What is the management team? Tech deep dive. Focus on the business plan for the company at the corporate level. And their first of a kind commercial would usually be funded either by strategic capital or on balance sheet, because there was an abundance of capital and an era of free money, and there was venture debt and other structures that they could employ. So that was very different from infrastructure capital, where you have the focus is on capital preservation, high capital cost for diligence, long underwriting cycles, control structures, and long-term hold by investors. But now these two very historically, very, very discrete spaces are starting to blend, particularly because, with high interest rates that we have today in this high interest environment, as well as, the VCs having, over the past couple of years, especially in climate tech, returned lower distributions, fewer distributions to their own LPs, they have become a bit more risk averse. Then you have the collapse of institutions that historically were, very available for these types of deployments, like Silicon Valley Bank. And this has created now a gap, this missing middle again, in the space. And some interesting data from, Sightline is that for the price letter rounds, investments, total dollar values over the last year have dropped, anywhere between 10 to 50%. So the graduation rates for companies that are moving from their TRL7 into post commercialization have dropped precipitously down to 20% as of the end of 2023. So that creates a gap. That creates a real gap, because you have abundance of VC capital that is now today more risk averse, north of, dry powder 100 billion. Then you have infrastructure capital on the other side of what I like to think as an hourglass, north again, a ton of dry powder that is concentrated in billion-dollar funds. So, and another thing to note is here is that they're a fund that, a $5 billion fund, like some of the infrastructure mega funds, will not solve the problem, because their minimum equity ticket is going to be $500-600 million. Where the problem lies for most first of a kind facilities is, anywhere between, $15-20 million and $150-200 million. So, that necessitates the creation of a new asset class or a new type of product for the space that has the sophistication of, infrastructure investing and underwriting, at the same time is able to collaborate and view, the value and understand the technologies and management teams and collaborate with the rest of the ecosystem like venture capitalists do, and be the enabler in this space. They need to be able to, understand the technology, so take some tech risk, but also have incredible capabilities and understanding of how project development works. And they will typically look for outsized returns compared to traditional infra, but will be cheaper and potentially off balance sheet compared to, in contrast to corporate balance sheets. So that's the area that we as Wavelength are trying to unlock. We observe that the climate tech market necessitates the creation of this new asset class. It will be outsized returns compared to traditional value add infrastructure, but it will bring and marry these two sectors to enable all these technologies to graduate, into commercial scale, into being able to solicit project debt and get other creative and lower cost of capital solutions. So that's really important. So, that's an aspect of what we do at Wavelength. And, separately, we work with a lot of these companies because it's also really important to provide the education into the ecosystem. And so we work with a lot of these companies to help them who have typically demonstrated their technology at scale. We work with them to help them prepare against this new reality where, there is no more free money, like help them understand and map who the stakeholders are, create their financing roadmaps and industry connectivity in order to be able to find who the right capital partners are and how to sequence and structure, their plans in order to, maximize the success of their early commercial facilities.
Okay, so does that mean, technically speaking, from a corporate structure perspective, would that mean setting up something like a ring-fenced entity the way you would in order to issue project finance, except you would have the equity in that sort of off-balance sheet structure instead of the debt?
That's exactly right. I think, it's the type of equity capital would be flexible, but it would be predominantly equity. You would look to create, special purpose vehicles where, the company would drop in its early assets. There would probably be some sort of additional, rights to the projects kind of following the first of a kind in order to buy down, your higher risk with the first project. And then you would look, in some cases, you would look for some participation at the corporate level. But ultimately, you're approaching this differently from a growth equity investor, say, who comes in into the growth at the topco level, and potentially offers capital to deploy assets. We would come inversely. We would bring in capital at the project level. It would be more. It would be cheaper, but there would be some upside considerations or ways to buy down essentially the early risk.
And then operationally, I would imagine from a skill set perspective, this would not be growth equity guys. These would be ex-infrastructure guys or ex-bankers that worked in project finance and structured finance that knows how to do that kind of due diligence, like project level due diligence, which project finance, that could take a year sometimes, right? So the skill set is really coming from that end of the spectrum where you're working and collaborating with startups for very early on to make sure that they have secured the right engineering partners and the right terms on the offtake agreement. And then, you would set up that entity. So you're basically working alongside the banks as they're issuing project finance potentially, right?
That's exactly right. Yeah, I mean, in terms of the underwriting skill set, I think it's important to bring project financiers or infrastructure investors into such a vehicle. At the same time, it's critical that you also have and are able to articulate some of the merits of a deal from a venture capital perspective. What is your total addressable market? Because ultimately, you need to be able to think about whether this technology can proliferate and, whether there is enough of a market for you to then sell it, sell this platform, to a GIC or to some, other more permanent, lower cost of capital player. So, something that we might talk about a bit later, but, you want to be able to underwrite a first of a kind or early of a kind, platform. You don't want to underwrite a one of a kind. And it's a very important distinction. So, that's how I want to think about it. And these are the skill sets, that when I think about, how do you staff up a platform like this, it takes a village, and it takes folks from, across, I would say, the ecosystem project development expertise, venture, bringing in venture capital expertise as well, and technological, savviness, but also the sophistication and underwriting and diligence, kind of, the rigorous diligence that comes with infrastructure underwriting.
And can I just ask what Frontier is doing with advanced market commitments? Could that potentially serve as a model in order to create some sort of vehicle to also closely work with corporates and align with corporates? Like, is there a scenario in which you could get a number of, let's just say, like energy traders or corporates that are willing to potentially do these offtake agreements, be the buyers for them, and in a similar way that Frontier has set up for advanced market commitments for carbon removals?
Absolutely. I think, what Frontier is doing is very critical. I think, earlier in the podcast, we discussed about what the Canada Growth Fund does in a similar capacity by providing, firm offtakes for, carbon pricing or carbon credits. Then similarly, the US government does that for hydrogen. You see Frontier, Microsoft is spearheading a coalition for, green steel procurement. So you are seeing collectives and coalitions of strategics that are coming in and providing these fixed price firm offtakes. Also, a great example is, in the SAF space as well, you're seeing, airline groups that, come in and are starting to procure, SAF from platforms, at scale. Where most recently, American Airlines came in to Infinium as well, and which was a breakthrough catalyst deal late last year, phenomenal deal, and similarly provide an offtake in a space that traditionally has just not lended itself to long-term contracts, and that's how you unlock these first of a kind or early of a kind spaces. You need people who will and partners who will take this risk, who will help you render your project, more bankable. And, it comes down to, contracts. And it's really critical for, folks who are infrastructure investors, to be able to see that, because you want to reduce the risks in your project. And you think about, risk mitigation. Not everything can be first of a kind, and you can't, take market risk, feedstock risk, construction risk, tech risk, operational risk. You need to start reducing those degrees of freedom in the project in order to be able to bring that lower cost of capital.
Got it. Can we get a little bit more granular and talk about some case studies or recent transactions for these early infrastructure projects?
Absolutely. I'm glad that the term early infrastructure is starting to take. I'm going to keep trying to push for it.
We're going to start it. We're going to launch it in this podcast. We're going to make it viral, and we are going to retire the term first of a kind. Let's see how effective that is.
So I think there are two great examples to discuss a bit. The first one, which is which also reminds me a lot of the the LNG deployments of the 2010s, is H2 Green Steel's plant in Boden in Sweden. The H2 Green Steel is a company that basically takes use electrolyzers to produce hydrogen from electricity, and then uses that hydrogen to produce green steel. So they claim to be able to reduce basically the carbon emissions, in the steel in the steel making process by 80 to 90%, 80 to 95%. So those guys were able to have made some terrific announcements. In the second half of last year, they raised north of 6 billion euros in capital. And for a first of a kind facility, which is staggering. So how did they do that? I think what it comes down to, it's something we discussed a bit earlier: contracts. They were able to secure offtakes for north of 50% of the capacity of the plant before bringing in their equity investors into the plant. And who were these offtakes with? They were with the BMWs, with the Mercedeses of the world, with Permagroup, with Kirchhoff Auto. So they are, very reputable, users of green steel with stated decarbonization targets, in a space that typically has not had long-term contracts, but they gave, H2 Green Steel 5 to 7 year offtakes. And when you're able to, build, when you're able to secure offtakes for north of 50 to 60% of your facility, then you can bring in, equity capital that's lower cost, and that starts to make more sense. So, investors into H2 Green Steel in that round in September were, the likes of Just Climate, who's a great player in the decarbonization space, a hydrogen joint venture, led by Ardian, as well as GIC. So you see, very mature investors who typically, focus on, infrastructure coming into a space that is, more novel because they had all these offtakes. In parallel, after the equity round, something that they did extremely well was, a very concrete and very fascinating project finance structure, where they raised on top of their equity, they raised north of $4 billion of debt, with that was enhanced by two agencies, one being the Swedish National Office, and the other was Euler Hermes, which is a German export credit agency. And because part of their equipment came from Germany. So similarly, in a project finance I was involved with, in the natural gas power in the natural gas fired power plant space in the late 2010s, we were able to. It was in Brazil. And it was tough to bring in project finance, because it was in a risky kind of geopolitically space, and also it was the largest natural gas fired power plant in Latin America. But what we did similarly was we brought SERV, the Swiss export credit agency, to enhance the debt on the project, the credit of the project, because we had equipment from GE, which was and it was their Swiss team. So in a similar way, H2 Green Steel used by procuring equipment from Germany and bringing and being able to enhance the credit of their project with these mechanisms. They were able to then bring behind that, they were able to enhance the credit by 80 to 90% loan coverage, and they brought in everyone. They brought in SEK, the Swedish bank, EIB, and ING, BNP, UniCredit, a bunch of typical traditional project financiers, because now you've basically structured the risk away, and that is a fantastic first of a kind project that I think merits a lot of attention. Obviously, different scale from a lot of technologies that are coming to market, but I think it was a testament to structuring project finance in a space that with pretty high technological risk at this stage still. So hydrogen is obviously now becoming less and less risky and underwritable, but it was a great project to see secure financing, and the way they did it was should be a great example and paradigm for other companies looking to commercialize their technology.
That was really interesting, the example that you provided from working on the Brazil deal. Do you have any other examples that we can chat about? I definitely need to delve into H2 Green Steel, because that deal is, well, as you know, I've been trying to reach out to their company to get somebody to chat with me. So hopefully that works out.
Yeah, no, they're fantastic. But the way these guys, were able to structure this really represents, project finance use as using project finance in a novel space. They did everything right. They took years. They structured the deal. They brought in the right offtakes. They secured long-term PPAs in a very cheap region, where cheap green electricity exists, like Sweden. And they structured the risk away, and that's what you need to do and think about, when you build these first of a kind facilities. As another example that I think is also a bit more salient and recent as well is the Infinium deal. Those guys basically, they take waste CO2 and they convert it to SAF, to sustainable aviation fuel. You will see some parallels with H2 Green Steel, because jet fuel, again, historically not a commodity where you find long-term contracts. This is like annual, volume commitments. What did they do? So Catalyst was able to invest $75 million in their first of a kind brownfield gas to liquids conversion facility. And what they bring, and what Breakthrough was able to help Infinium with, was negotiate with American Airlines a firm offtake. So again, you see the ability to bring in, in order for these technologies to bridge this gap, you need to bring in contract finance. You need to be able to structure the risk in this circumstance. And again, Infinium, it's a partially new technology, but in this case, they are retrofitting an existing facility. So partially, de-risking in that sense. It's not, fully de novo. You have a firm offtake from American. At the same time, American negotiated an agreement where they are transferring the credits to Citi. Citi is a breakthrough partner. So you are seeing this ecosystem at play where, American isn't taking naked risk. They are also, able to structure the credit transfer with Citi. And that is important because then that allowed them to, be able to procure, under a long-term agreement, SAF from Infinium, and we're able to basically, create this underwritable structure for Catalyst to come in. So that is another great example, and of a project that I think is important, and it's more digestible. I would say, it's like 75 million compared to $6 billion, and perhaps a lot more, perhaps similarly relevant for technologies that are being deployed in across kind of the decarbonization space. So I think that's also a great example. And if I were to think about a couple of other examples or case studies, I think it's important, and something that we discussed a bit earlier, to think about other opportunities where maybe they weren't specifically first of a kind investments, but they were investments that enabled first deployments at the top level by strategic investors. So, I think we brought up a couple earlier. One was Fervo with Devon Energy. Devon is a fracking company. Another example is Energy X. It's a lithium extraction business. Their Series B was led by GM Ventures. So that way GM gains access to a material that is critical for their batteries, for their electric vehicles. Similarly, Amogy, it's an ammonia to power business. Their Series B was led by SK Innovation. SK is a big contractor. So you're seeing this ecosystem and these strategics coming to play, and I think it's something that you raised as well. The strategics will play a critical role. The incumbents, in other parts of the technology kind of universe or the tech universe, you want to disrupt the incumbents. You want to become the new incumbent. In this space, everyone has to work together. Everyone has to work together to unlock and deploy these technologies. And that's what I think, as infrastructure investors, we want to borrow from the VC universe. You need the collaboration. You need to bring in everyone to commercialize these technologies. There's enough white space for every player in the ecosystem.
Oh God, I wish we could make this a 2-hour podcast. I have so many questions to ask you. Okay, running through that list, obviously there aren't that many examples in this early infrastructure arena, but most of them sort of relate to energy deals, or I guess sustainable aviation fuel as well, and then green steel. Could this model of offtake agreements, securing the offtake agreements, and then getting the project finance and potentially partners like you work for other industries like is agriculture or stuff in the circular economy, things like that? Can you replicate it into those areas?
Absolutely. I think it's a very relevant point. In ag tech, it's part of the solution, and it's obviously in an area, and maybe that feeds a bit into adaptation as well. Whether if that might feed a bit into adaptation, but ag tech and improving yields in a world that is so affected by climate change, it's critical, and especially because agriculture consumes a lot of raw goods, whether that's electricity or fuels or water. You need to find ways to bring these technology to find ways to, with technological enhancements or new technologies, increase the yields in a climate conscious way. There are a lot of companies out there that are doing that, and we have spent time in ag tech. So a great company is Nitricity. They're good friends from our EIP days. They are producing basically fertilizer through electricity with a very interesting technology. I think it's a great example, of the application of first of a kind into the ag tech space, and there are a lot of other examples. But kind of borrowing from the case studies that we discussed, you want to be in a space that traditionally doesn't have long term contracts. How can you bring in strategic partners, whether those, let's take agriculture, as the example here. Can you have distributors or other strategic partners, or, large, produce players, come in, with strategic capital, either to invest in your project or commit, because they want their own operations to get greener. So if you can offer them those credits, or if you can, give them the opportunity to display that, or demonstrate to their own investors, and kind of like, that they are, progressing in their decarbonization targets. Can you form these partnerships in order to secure long-term agreements? And with the long-term agreements, you're able to de-risk these projects and bring in asset level capital. So it's some spaces are a bit more difficult than others, admittedly. Obviously, mining and agriculture, you see the commodity. The commodity price is kind of like, being extremely volatile at times. And, it really depends on the type of product. But, there are kind of like bright examples and opportunities in every space, that can borrow from the first of a kind space that we think about, a more mainstream decarbonization.
On that theme of borrowing, are there learnings from the evolution of the financing market in solar and wind, and especially liquefied natural gas, that we can then apply here? I mean, that obviously solar and wind has been developing over time. There's debt that's specifically issued for those types of projects. There's credit derivatives. There's stuff that you could do in the public markets. There's so many. I mean, there's a lot of financial ingenuity in those markets. So is there stuff that we can, this is not a short question, but I'm sorry. I should have asked you that starting out, but can we learn anything from those markets?
Yes, absolutely. It's not a short question. It's definitely not a short question, not a short answer, but one of the most important questions, right? I mean, we have to look at the examples of the technologies that we look at today as, the big siblings of all these decarbonization pathways. And how do we want to, a big part of the work that, we think about at Wavelength and want to do is, how do we take the renewables playbook, replicate it? How do we create the next solar industry? So, kind of like a quick history lesson, with solar, solar didn't really become a big thing outside of, space exploration or targeted experiments until the 70s. The oil embargo of 1973 is really what started, piquing the interest of the U.S. Into alternative solutions to fossil fuels that would be economic. So that's when real research started going into solar. Costs, dropped 80% for panels, and then over the coming decades, you start seeing, the quantification of climate change, incentives for better lifestyle, and also the tax incentives and actual federal and government incentives. From in Germany, for example, there was a solar roof program, and in the U.S., with what really spurred Cleantech 1.0 was, the investment tax credit, which is still very much widely applied today. And there's a whole industry around investment tax credit, which is tax equity. And that started in 2005 and really supercharged the growth of the renewable space. And so that growth and that government participation also brought in venture capital, private equity behind it, to support the solar industry. And of course, when you see all this private capital come to market, that's when I was going to say fee chasers, but I'm going to change that. That's when, the rest of the capital system participates. So you see banks now coming in, providing project financing, similar to structures, project financing that they would historically provide in traditional infrastructure or fossil fuel generation. And then also you have, insurance providers and insurance companies and reinsurers come in. So if we are to, and obviously with the advent of all this capital and research, you see, the cost curves, move down substantially. In the past decade, the cost for solar panels have dropped, 90%. Efficiency has increased. We're seeing a similar trend in batteries as well. Obviously, batteries are now part of the IRA as well, and they can benefit from the incentive tax and investment tax credit program. So with all that, the big lessons here, right, with solar are you need demand side triggers. So with solar, it was the oil embargo. In our day and age, with climate change, you have quantifiable climate disasters, and you have the geopolitical uncertainty in the world right now is causing massive price fluctuations in power prices in Europe and in North America. And so these technologies are now necessitated. We need alternatives. These are demand side triggers. Then you need government support, which has obviously we've the IRA in the U.S., the bipartisan infrastructure bill, over in the EU, the Green Deal. There is government support. Scale deployment, which is where FOAK comes in, and early infrastructure. How do you bring these technological decarbonization pathways to market, and cost downs, and very measurable, effective cost downs to make it worth the early risk taken. So that's a great example from I think it's the solar industry is a great example, and kind of I would say map to other decarbonization pathways and energy transition technologies, because of that. And we are in a place where all these elements are kind of like in place, to enable these technologies to come to scale and become the next solars. And moving to LNG, I think that is a space that I hold near and dear, and also it's very relevant because it takes so much project development. It is at scale. I think with LNG, what we have seen, and what is important to kind of take from those lessons is the extremely deep structuring. So the Cheniers and the Sempras of the world, they had at least 60 to 70% of their facilities, their early facilities, committed with long-term 10 to 20-year contracts before they took FID on these plants. So you don't go fully naked into starting construction. Modularization is very critical. You need to think about scaling up smartly. You can't just go from 1 gram to 1 ton. You need to think about what makes sense. How much can I commit and de-risk the project? Because especially for LNG, it was like $1 billion projects. $3-4 billion per total capex. You need to think about deploying smartly. Start with a balance of plan and train 1. Once train 1 is complete and fully committed, build train 2, et cetera, et cetera. So in a similar way, if you can modularize your technology, in the climate tech space, it would be incredibly helpful, to investors and folks that will underwrite your projects. And then general structuring, I think, thinking about your feedstock, your EPC contracts, who's going to wrap the plant. I mean, EPC wrapping is perhaps not as available in first of a kind technologies, but you can perhaps start by thinking, okay, do I need to reinvent the wheel across the whole facility, or can I focus on a specific innovation for the first facility and start there? And then, gradually, as I prove out, the individual components, I can change the whole process. And being able to integrate your IP with, a very proven kind of deployment approach will be very critical for, prospective developers. And I think that's really important. Long-term agreements, even if you need to cap the upside, by not having kind of like full exposure to your supply or merchant risk on the demand side, it's worth it for your early projects. You need that. You need to make your projects bankable. Cannot stress this enough. Tons of planning, obviously sequencing, permitting, offtakes, siting, regulations, having the right groups kind of like focus on where to site your first of a kind facility. That's critical. And then, in terms of financing, obviously bringing in the right capital partners, at the asset level, at the topco level, structured equity, vendor notes, partnering with strategics. And then, you saw in the LNG space, right? We saw the Shells and the Exxons and, the natural gas providers, ultimately, they got themselves into liquefaction and, even into shipping, et cetera. So you're seeing the ecosystem kind of blend, and it's critical because, it's really critical for everyone to share that risk. And it's about risk transfer and risk sharing. So, taking these learnings, I think, from LNG is critical. I think it's, extremely deep structuring, risk mitigation, and I think it's going to be particularly helpful as an industry for carbon capture sequestration, which faces similar, issues, as well as hydrogen development. So those, I think, are pretty great learnings. And I would even add for LNG, another thing that I was thinking about is if we can think about the LNG shipping space, and how some firms and operators were able to innovate by thinking, okay, how can we unlock stranded gas reserves in the middle of the ocean, and they build floating liquefaction facilities, FLNGs, or how can you bring cheap gas in an era of cheap gas? How can you bring that to other geographies, in the emerging countries, and displace heavy fuel oil, which is energy transition in a form, energy transition, I would say 1.5. So in that sense, you saw the retrofits of existing ships with partial innovations to be able to perform these operations. And you got wraps by the Keppels, the Dalians, the shipyards of the world, in where it was basically possible to structure again and reduce your risk and mitigate all your technological and construction risks for these $100 million projects, which is the retrofit for each ship. But you were using an existing shell, and were able to basically innovate on top of that. And you see that, there are examples of technologies in our space that could borrow from that example, which is don't recreate the wheel. Commercial EVs, for example. So as the industry and adoption proliferates in the EV space, you're going to see some bidirectional charging and discharging. So for load management, so you will see electric buses, electric trucks, when they're plugged in, they are batteries. They're basically batteries for the grid, and they can support that load flexibility. You don't need to reinvent. Think about that. Think about grid management. Then using existing infrastructure, for green ammonia. So the ammonia is a component of it's a fertilizer. It's part of it's used to produce fertilizer. So using that existing infrastructure is critical. That way you don't have to create the infrastructure for a whole industry. You can isolate the areas where you can innovate, and that is very critical.
Okay, final question, only because we're unfortunately running out of time. You've already covered a bunch of this stuff, and I know that there is no real playbook for a early infrastructure project. I'm doing good with the early infrastructure. I feel like I haven't been saying first of a kind that much.
I think I'm doing worse than you.
I think you are, yeah. But here's the thing. I'm going to have to title the episode with first of a kind, because otherwise people won't know how to search for it. But at some point, when we make the early infrastructure thing go viral, we can then transition over.
Right. Yeah. We'll be key champions of it.
Yeah. Okay. So final question is really, is there a checklist for a startup? You covered a number of things already. You talked quite a bit around de-risking, but if there's anything more on the de-risking side, and then something very critical that we actually didn't talk about that much was staffing, right? Because at that stage, a lot of these founders are scientists. By the time they get to Series A, they have to get not just people who have commercial and operational expertise, but they also have to get people who understand finance to figure out how to structure these deals. So to the extent possible, if you could just try to list off a few things that might be part of a checklist for a startup.
Of course, it's really part of the work that we do as Wavelength with our counterparts in the industry. Creating these checklists and customizing them, for the needs of each company. But you're hitting the nail on the head there. First of all, the most important thing is team build. Plan years in advance and plan for your project to take years to be completed. So that will require not just your technology engineers, it will require project engineers. It will require planning and permitting experts, cost engineering, contracts experts, project financing, regulatory experts, community engagement folks. You need to be, at least for your first of a kind project, or early climate infra project, you need to think as like a project developer. You're not just the OEM of the technology. You're also your own customer as the OEM, as the manufacturer. So you need to think about it that way. And that is going to be, your proof point for the commercialization and litmus test for your technology, to hit scale. So I think, team build is critical. It's kind of the first thing that we think about. Great examples are, our friends over at Rondo Energy and Last Energy. Those are, a heat battery company and a small modular nuclear company. They both have, project finance functions, years in advance of their first of a kind. Very important build. The second, the very, very important element. The second thing on the checklist, I would say, is contracts. Contracts. Bankability, is synonymous with, project finance, which also goes by contract finance in academic circles. So really, it's contract finance. Get these contracts, and then you can unlock financing. Structure long-term price and volume defined agreements, both on the supply and the demand side, in order to reduce the risks in your project and reduce the degrees of freedom, for things to go bad, for things to go wrong. And then, I would say, the third item is tech demonstration at a reasonable scale. So be very measured and reasonable with your scale up plans. Don't try 1,000 X scale up. It's just not going to work. Because you see some inventors or some companies that are post Series A. They're like, okay, we have a technology that's producing. We have proven that the technology works with 50 kind of like let's just use like a random unit of measurement. It produces like 1 grammar. But now we think that we can produce 1 ton, and that just does not fly with investors. It will, because like if the modularization is key here. How can you create something that then you can stack like Legos, or how can you find a way where you don't have to reinvent the whole process for scale? So the orders of magnitude that you're thinking about need to be very careful and measured in order to attract lower cost capital. Otherwise, it's just going to be full tech risk all over again. So that's really important. Then, I think that the other thing that we talked about earlier is focus on your first of a kind, not your one of a kind facility. How can you standardize and templatize your work? And that really is something on the checklist that comes from our friends in the project finance and insurance world, because otherwise there's just like, you're not going to incent the broader capital system to participate in your technology if you don't have a standard. If every time you deploy your projects, they're fully bespoke, you need to be able to standardize the technology and deploy it at scale. So that is really critical. It's an example. Bloom Energy is doing that well with their fuel cells. Obviously, it's now a mid-maturity company, but earlier days they were able. You're able to basically deploy these fuel cells, and they're modularized. So you just deploy more if you want bigger scale, and they're great with the real estate they're commanding. So I think that's also really critical. And then the other critical thing is, focusing also not just on your first of a kind, but on your projects number 2 through 5, 6. A project will start, garnering interest in the project finance world and the lower cost capital space after project 6 or so. So your first project is going to be, a mix of catalytic capital, maybe an equity investor, maybe a first of a kind investor, and growth equity. But you need to start planning. How do you attract interest, how do you show, and that's, something that you underwrite as a venture capitalist as well. It's how do you show that you're starting to command a market share from your total addressable market? Do you have firm commitments for projects 2 to 5? If project 1 succeeds, do you have another 3, 4 projects behind it that, you can deploy and will be working on in parallel? Because again, no one wants to bet the ranch, at least no one in the infrastructure world. So, being able to demonstrate that pipeline and with firm commitments, whether that's from customers or site control, it's really important. It's really important for investors in this space. So that's something that we all, that we also look for with companies in companies that we work with. And finally, I think, strategic interest is really critical. Being able to see, and it's something we've discussed a lot in this podcast. Being able to map the incumbents, see if they can come in some form or way, collaborate. It's really critical that you bring everyone in the mix. So these are the main things that we look for. And maybe one thing that is obvious, but worth noting. The business plan, right? The math for a first of a kind will probably work with catalytic capital or tax incentives and other structures, grants, etc. But how can you demonstrate that your plant number 3, number 4 will work without catalytic capital? or otherwise there's no point. There's no point in even assessing the first one. So demonstrating very quantifiably and with very concrete results the cost down of your technology is critical, because otherwise it's you don't want to again invest in one project. As an early investor in this technology, you want to be early in a big industry. So this is mostly I would say these are the key elements. And if we were to call it a checklist that we look for in technologies that we assess, to deploy capital or to advise and work with, in order to get them past their first of a kind project deployments.
Thank you, Petros. That was so helpful, and I have many more questions, so you're just going to have to come back.
I would love to. I know we have other topics to talk about in the space, and really look forward to continuing these conversations. And Sami, I can't thank you enough for this work. I think it's critical that more and more people get educated on how the space works, especially the founders who are bringing these technologies to market and who will be everyone needs to be part of the solution.
And that is it for today's episode with Petros Lakakis. If you found it useful, please subscribe and leave a positive review, as that helps new listeners discover the show. Thank you so much for listening, and I hope to catch you at the next one. Bye, everyone.